So if you believe what Ben Graham said, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined process to buy perhaps more than your fair share when they're below the line, and if so inclined, sell or short more than your fair share when they're above the line, the market is throwing us pitches all of the time.
What Joel Greenbalt is referring to here is investing with his magic formula from his book, The Little Book That Beats the Market. And before you click away, no, this is not some scam. This formula truly works and returned an average of 40% a year over more than 2 decades. That would turn $1,000 into well over $750,000. In this video, we have broken down Joel's magic formula into a 3-part blueprint that, if you follow, will lead to investing success. And it starts with part 1, the concept. Put simply, the magic formula is a tool for individual investors to pick quality stocks at bargain prices. The stock market, in the short term, can be highly emotional, causing wild fluctuations in stock prices. Companies can become overvalued due to hype or undervalued due to short-term bad news. The simplicity of the magic formula aims to exploit these inefficiencies by systematically identifying stocks that are undervalued but belong to companies that are fundamentally efficient and profitable. It cuts through the complexities of stock analysis and provides a systematic approach to investing, drawing on 2 primary metrics: return on capital, ROC, and earnings yield, EP. The essence of value investing is not just about buying cheap stocks, it's about buying great companies at a fair price. The quality of a company is often gauged by how well it turns its assets into profits. This is where return on capital comes into play. Return on capital is how efficiently a company utilizes its capital to generate profits. Think of ROC as a measure of a company's financial productivity. If Company A and Company B both have $100 to invest, but Company A generates $20 in profit, while Company B only generates $10, Company A is more efficient and will have a higher ROC. A higher return on capital is a signal of managerial efficiency and often points towards a durable competitive advantage. By ranking companies based on ROC, you're effectively sorting them by operational efficiency. However, it's no good buying companies that have a good ROC but are extremely overvalued. The goal of value investing is to buy a dollar for 50 cents. The earnings yield acts as a metric to find such bargains. A high EP indicates that you are getting a lot of earnings for every dollar you invest in that stock, implying that the stock might be undervalued. Furthermore, a key reason the magic formula has been so effective is the idea of the reversion to the mean. This means that over time, the performance of companies and their stock prices will move towards an average. Quality companies that are undervalued due to market overreaction, short-term bad news, or other reasons are likely to see their stock prices correct upwards over time. But how does the formula actually work, you may ask? Well, that leads us on to part 2, the method. The process itself is very simple. All stocks in the market are initially ranked based on their individual ROC and EP scores. After ranking is complete, the 2 ranks are added together for each company. For example, if Company X was ranked 5th based on ROC and 7th based on EP, its combined rank would be 12. The top 20 to 30 companies with the lowest combined rank represent good companies, based on ROC, that are available at attractive prices, based on EP. Greenblat suggests buying these top stocks and holding them for a year. After that period, the portfolio should be reevaluated based on the updated rankings. Sell the stocks no longer in the top 20 or 30 and buy the new entrants. Historically, there have been periods where the magic formula strategy underperformed the market. For example, during the tech bubble of the late 1990s, many value stocks seemed to stagnate while tech companies soared. However, post the bubble burst, many tech stocks faced sharp declines, while value stocks remained more stable, validating the magic formula approach for many of its proponents. You can access the current top 20 to 30 companies by going to the Magic Formula Screener on Joel Greenbalt's official website. Watch until the very end of the video, and we will go back over this process in a step-by-step format for you to follow along with the exact website to find the screener. But it all seems a little too perfect, doesn't it? And that's where we get to the final part of our blueprint, the catch. Firstly, one of the most challenging periods for an investor following the magic formula, or any strategy, is during times of underperformance. It's easy to second-guess the strategy when it seems like everyone else is earning significant returns, and your portfolio is lagging. Emotional discipline is about sticking to the plan even when it feels uncomfortable. This isn't about blind faith, but rather a trust in the underlying principles of the formula. In addition, the magic formula is fundamentally quantitative, relying on concrete metrics like ROC and EP. While these metrics can provide valuable insights, they don't paint the full picture. Factors like company management, competitive positioning, industry trends, and potential regulatory challenges can have significant impacts on a company's future prospects. Every investor has a unique risk tolerance, investment horizon, and belief system. Some might decide to adjust the magic formula criteria slightly based on their personal preferences or convictions. For example, an investor passionate about environmental issues might add an additional filter to exclude companies with poor environmental track records, even if they rank well according to the formula. So in summary, while the magic formula offers a systematic and methodical approach to stock selection, a well-rounded investment strategy typically involves a blend of both quantitative metrics and qualitative insights. Ensuring data accuracy and supplementing the formula with broader research can lead to a more comprehensive understanding of investment opportunities. We also strongly recommend reading the whole book itself, as not only is it a great read, but also a brilliant way to reinforce your understanding on the topic. And there you have it, a 3-step blueprint to the magic formula. For those that made it to the end, here is a step-by-step guide to using the formula that you can come back to anytime you need it. 1. Go to magicformulainvesting.com. 2. Choose a company size, 50 million or bigger should do. 3. Follow the instructions on the site to get a list of top-ranked magic formula companies. 4. Buy between 5 and 7 of these companies. Spend 20% to 33% of the capital that you intend to invest. 5. Repeat step 4 every 2 to 3 months until all your capital is invested. This should result in a portfolio of about 20 to 30 stocks. 6. Sell the stocks after holding them for a year. For tax purposes, hold the winners a few days longer than a year, and the losers a few days shorter. Repeat step 4 with the money from your selling. 7. Continue the process for many years. If you find investing to be a very challenging and stimulating interest of yours that you don't want to throw away for some automatic formula, with a name that makes it sound like a scam, by the way, you could use it for screening purposes only. For example, find the top 100 companies according to the magic formula, and then pick your favorite 10 out of those. And that's it. Good luck! We hope you enjoyed the video. Make sure to subscribe and support the channel if you found this useful, and we'll see you in the next one. This is not financial advice and is just general strategies. It's important to tailor your investment approach based on your specific circumstances, financial goals, and risk tolerance. Always do your own research or consider consulting with a financial advisor before making investment decisions.